Hey guys, what is going on? Welcome back to another video. As always, want to start off the video by saying thank you to all the subscribers, all the viewers, all the supporters on the channel, showing the channel so much support. Immensely appreciate it. If you guys do like the content, if you guys do like the video series, feel free to like, share, and subscribe. And if you are a subscriber, make sure to hit that bell button to get alerts and updates on all new content posted on the channel. For today's video, I'd like to talk about a couple strategies about putting money into a portfolio. A lot of you guys have been asking about buy and hold strategies. What's the best way of getting into a stock and then putting money into the market? So I thought I'd talk about two very powerful techniques that will kind of ensure that you don't have problems with market timing. That is, putting a bunch of money into the market when the price of a stock is high, then having the price of the stock drop. There's a couple different methods called dollar cost averaging as well as value cost averaging that kind of evens out the peaks and valleys. Yes, if you were able to put money into the market when the market was down, for example, let's say you put a bunch of money into the stock up on screen, AT&T, ticker symbol T. If you're able to put all of your money in here, that would be excellent, and then you'd have a very nice rate of return. However, if you timed it incorrectly and put money in here, then the price of the stock dropped. You'd have to wait quite a bit of time before even getting back to even and then making money after that. So dollar cost averaging and value cost averaging are ways to kind of get around the problem of market timing. That is, trying to time the market when it's down, which is not able to be done by anyone. If it was, you would have some very rich strategists out there that would simply put money in when the market was down. Unfortunately, you cannot do that. It's not a predictable thing. You can't really predict where the market's going with any certainty. So because of that, dollar cost averaging and value cost averaging are very good ways of getting around that. So the first method, dollar cost averaging, you're simply putting money into the market on very regular intervals. So you put money in here, you put money in here, so on and so forth, about the same time every month, or maybe you want to do it bi-weekly or weekly. You'd be putting money in on each one of these points here. So each one of these lines, you'd be putting a little bit of money in. And you can see here that these are corresponding to different prices in the stock. So sometimes when you put the money into the market, you'll be on highs. Other times you'll be on lows. Maybe you'll be on a high here, a low here. And over time, that will kind of balance itself out. You'll buy a few of the stocks when they're extremely expensive, but then you'll also be buying stocks when they are not as expensive, maybe even on discount. And over time, you'll have an average cost of all of those purchases. So rather than putting in one big purchase on this peak here or one big purchase on the valley here, you'd simply be spreading your money out over time, trying to get the best rate of return over the long haul. So this is for a buy and hold investor. This is not for a swing trader or a day trader. This is someone who wants to hold the stock for an extended period of time, maybe even 20, 30, 40 years. And over time, this is the best way of putting money into the market. However, like I said, there are some drawbacks. Because you're putting money in on highs as well as lows, you're not going to have the same rate of return than if you were to put money in on all of the lows here. It's really difficult to time out a stock when it gets to those lows. You can do, and what I like doing, is a contrarian investment model. I actually did this on AT&T. When the price of a stock drops below a certain point, you buy quite a bit of that stock, assuming or predicting that stock will go up in price. So I can make a very much higher rate of return than someone putting in money on a very regular basis on the highs and lows. But again, that is a very, very risky type of an investment. And the same holds true from any strategy in the stock market. The more risk that you employ in a trade, the more likely the return will be very, very good. So risk equals reward in the stock market. Dollar cost averaging is a way of getting rid of risk. So it also gets rid of some of the high rewards you can get as well. But over the long haul, you're really not looking to put money into risky investments. You want something in an investment that's very, very safe. And dollar cost averaging is probably the safest way of putting money into the market without worrying about market timing. And the other key drawback of dollar cost averaging is that you're putting in, like I said, money on regular intervals here. So you're essentially not putting in all the money that you have available. So a lot of your funds may be sitting in a very low yield savings account, or maybe even just in a checking account. So you can see that you also have that opportunity cost of all that interest and putting money into the market and letting it grow by just sitting in your savings or checking account. So those are the two big disadvantages, but the great advantage of dollar cost averaging is removing risk from your trade. Over the long haul, this has been proven to be one of the best ways of putting money into the market and being a very safe way of doing it. The other more sophisticated way is value cost averaging. This is a little bit more difficult to understand, to be quite honest. Value cost averaging, you're looking for a particular price point with regards to the overall portfolio and not putting in a set amount of money every month. So for example, if a stock is dropping like it is here, you can see how the stock is going down. You may want to say, here I want the value of the portfolio to be 500. Here I want it to be 1,000. Here I want it to be 1,500. So you're going to be putting money in to make the portfolio at this particular value. So depending on what the price of the stock is, you'll have different portfolio values. And the whole idea is that you're going to be putting more money in when the price of the stock is down on these values here, and you'll be putting less money in when it's on the peaks, because you're simply taking how many number of stocks you have times the price of the stock to get the overall portfolio value. Let's say it equals 1,000 here, and then you're going to the next interval. So whatever the price of the stock is, if it's a very high price, you'll be putting in less money to get to your next interval. Let's say it's 1,500, just because the number of stocks times the price of the stock will be a much higher value. So you'll be putting in less money on these peaks here. So unlike dollar cost averaging, where you're putting in maybe 100 here, 100 here, so on and so forth, with value cost averaging, you're going to be putting in a different amount depending on what the price of the stock is. So very, very simple way of explaining that is when the stock is high, you'll be buying less shares, and when the stock is low, you'll be buying more shares. Much more sophisticated way of doing dollar cost averaging, but a very, very good way of putting money into the market as well and getting rid of risk. Again, risk equals reward, so if you get rid of risk, you're also getting rid of a little bit of reward. But over the long term, this is the best way of putting money into the market. Again, this is a buy and hold investor, maybe putting in money for 20, 30, 40 years. So I hope that makes sense for you guys. That is dollar cost and value cost averaging. Dollar cost, you're simply putting in money at regular intervals, the same amount of money. And for value cost averaging, depending on where the stock price is, if it's high or if it's low, you'll be putting in less money when the stock price is high and putting in more money when the stock price is low. And again, that's going to vary a little bit depending on what kind of portfolio values you have, because you have to buy one complete share here on the portfolio. So if you were on, let's say this part here, you had $1,000 into the portfolio. The next one you wanted to put in $1,500. You'd simply kind of subtract what that price would be based off the value of the stocks in the portfolio, and maybe you need to buy 3 stocks, and that might be $1,550 because each stock price is $40 or so. So it's going to vary a little bit on the value cost averaging because you have to buy a complete stock. But value or dollar cost averaging a little bit easier because you just put a set amount of money in, or again, you could put a set amount of stocks in. Let's say you just buy 2 stocks every month, so you're putting in $80 every month, or maybe you're putting in 4 stocks every month. Very easy way of doing it. So when I say a set amount, it could be a set amount of shares per that particular stock. So that makes dollar cost averaging very easy. Value cost averaging is a little bit easier too, because when the stock price is down, you have more room to buy more shares to get into your portfolio value, and when it goes up, you just simply buy less shares. A little bit complicated. You can take a look on Google. Lots of resources. I kind of go through and explain this in very, very good detail. But look up dollar cost averaging and value cost averaging, 2 of the best ways of putting money into the market over the long term for buy and hold investors. So just wanted to go over that. There's been a lot of inquiry on the portfolio talking about the best way of doing buy and hold strategies, how to put the money in, how do I time the market? And the answer is I don't time the market. You put money in on a very regular basis. Over the long haul, you'll have a very good rate of return, minimizing the risk of market timing, as well as just having a very consistent way of putting money into the market. So you're very thorough with that, and you keep yourself disciplined as well, putting money in and not forgetting to put money in or using money for other purchases. Very disciplined way of putting money in, and a very a good way of reducing risk over the long term. So just wanted to quickly talk about that. If you guys have any questions about that or other questions, please let me know in the other videos. And not to make the video too long, I'll kind of end it here. As always, if you guys enjoy my videos, feel free to like, share, and subscribe. And until next video, we'll see you then.